Hey guys, Omar Khan here from Theta Trading, and today I'd like to talk to you about what happens when the stock market declines by 20% plus. So that means what happens when the S&P 500 experiences a 20% decline in a given time frame, okay? Now, the stock market on average over the last 50 years has gone up about 10-11%, but we do have these periods of time where the stock market goes down for whatever reason. Now, I want to give you a bit of background about my story. I've been investing since about the late 90s, and I have seen countless numbers of these corrections or bear markets, you want to call them. 20% plus would be a bear market. Okay. And there's a different reason for them every single time. And what happens with people is, there's an old saying by Warren Buffett, when others are fearful, be greedy, and when others are greedy, be fearful, okay? And it's a very difficult thing to do psychologically. Now, I've been around, like I said, since the late 90s investing, and I've seen countless numbers of these corrections, okay? 01, 02 was huge, and that was the tech crash, okay? 07, 08, 09, well, more 08, 09, that was the housing bubble, and other ones as well. Now, those two have been the biggest ones, but guess what happened every single time? The stock market returned to an all-time high. Now, another few things I want to tell you about is when the markets decline by this much, what's going to happen is you're going to get the maximum amount of fear in the media. Media is going to scare the hell out of you. They're going to tell you the world's coming to an end and nothing's ever going to improve again and things are only going to get worse. But remember, the stock market is actually a forward-looking mechanism, right? It's pricing in today what it believes is going to happen, let's say, in 12 months from now or 6 months from now. So it's already priced in all the stuff that the media is talking about. So all that negativity, all that stuff that's the media is talking about, all the stuff that you see in the news, that is just going to freak you out. But the thing I want you to remember is when others are fearful, be greedy, okay? Now, like I said, every single time a different reason has been the case for a market decline, whatever that reason happens to be. It could be inflation, it could be a war, it could be high oil prices, it could be interest rates, it could be a credit issue, it could be a recession, it could be whatever. These are all the things that have happened. But during all that time, okay, the markets have always gone to an all-time high, which means eventually, historically speaking, we would expect this market to go to an all-time high. So what do you do when the market goes down by 20% plus? Well, let's take a look at what happened this time, okay? So in 2020, we hit COVID and we had a massive 35% decline in the S&P 500, way more than 20%. And what the central banks around the world did was so that the economy doesn't completely collapse is they printed a bunch of money. Just printed, and handed out money so that people could spend money. And if they spend money, that means corporations are doing okay, jobs are still being created. They did all that stuff. Now, there is a consequence to that. So now what has happened 2+ years later is this nasty word called inflation. And inflation is too much money chasing too little goods and services. And that's exactly what's occurred in the last couple of years. So you've had all this money that's been printed and then been given out to people in the form of stimulus checks and whatnot. And that's all pumping throughout the economy. And that is chasing too little goods and services. And you combine that with a supply chain issue, right? A lot of issues in getting supply, chip manufacturing, that type of stuff, and this obviously nasty war in the Ukraine. All that has combined to lead to higher prices. Now, what do the banks do when they have higher prices? The central banks, I mean, the Federal Reserve, the Bank of Canada. Well, what they do is they increase interest rates, okay? They increase interest rates to the point where they slow the economy down. And when they slow the economy down, people buy less goods and less services, thus lowering prices. That is what they're trying to do. So now, I want you to take a look at this graph and see what happens over the next 12 months after you experience a 20% decline since World War II, okay? Now, over the 12 months following your buys, your average total return would have been 22.7%. That's more than double the stock market's long-term average, as you can see from this chart. So this is buying when the stock market hits 20%. Why? Because the stock market has always gone to an all-time high because corporate profitability and our lives continue to get better. So you can see in the next year, okay, if you bought, on average, you'd have about a little over 10% return. That's just at any given time. But if you bought after a 20% decline, as soon as that 20% decline happens, and you should keep this in mind for future reference as well, Remember all the fear, all the negativity out there. Remember what history tells you. Remember what evidence tells you. Evidence and history tells you that that is not the case. The markets probably will not get worse. They may get a little bit worse, but at some point in time, they're going to recover, and they'll recover sharply, historically anyways. So after the next 12 months, after a 20% decline, you had an average of 22.7% return. And that is a huge return. So last thing I want to leave you with, guys, is I've been watching the news just like you guys over the last 6, 7, 8 months. January 3rd was the market top, and here we are in August, and the market is down a substantial amount. Still, it's bounced a bit off its top, but how negative has the news been? There's been nothing but negativity, and I want you to remember that for the future. When all the naysayers are doom and gloom, and the world's coming to an end, and things aren't going to get any worse, and they just keep getting worse, and recession is going to get worse, and blah blah blah, and blah blah blah, all that stuff. When all that happens, and the market keeps taking all that negative news and trading lower and lower, and fear keeps increasing higher and higher and higher, that is when you want to be opportunistic. And the exact opposite holds true, okay? When there's nothing but sunshine and rainbows, and the world is going nowhere but up, and stocks can't lose, and that happens with any market, by the way, whether it be the housing market or real estate market, that is when you want to be cautious, okay? We use these as contrarian indicators. When everyone is doing one thing, we want to do something else. So when everyone else is selling their stocks, that's when we want to be buying our stocks. And now we just saw the same recent phenomena in the housing market. The housing market has been on fire the last few years, especially the last 2 or 3 years. And people are like, the housing market can't possibly go down, and demographics and lack of supply and all this other stuff. Well, what happens? Interest rates went up, and now housing is taking quite a beating. It doesn't mean it's not going to return to an all-time high. It doesn't mean that it's not going to bounce back. It just means, remember that fear and greed thing. When others are fearful, be greedy. And when others are greedy, be fearful. Omar Khan here from Theta Trading. Thank you guys so much for watching this video. I hope you guys liked it. Please hit that like button, hit that subscribe button. And if you want to see any future content, give us a message. Shoot us a message. What would you like to see? I love creating these videos, but I'd love to see what you guys want to see. Until next time, take care. Talk soon.